50% of deals fail during the due diligence process. That's a very steep ratio. When you are in the due diligence phase of the fundraising process, the end is near, but don't be mistaken. It's important for you to be well prepared. Welcome back to Fundraising on the Go, the podcast brought to you by PwC Next Level, where we unravel the mysteries of fundraising for startups. I am your host, Otito Dosumu, and I'm excited to have you join us today. In our previous episodes, we've explored term sheets and negotiating. Today, we are diving deep into a crucial phase of the fundraising journey, which is the due diligence phase. This is the 10th episode of our series, and we're excited to equip you with insights that would empower you to navigate this critical phase with confidence. Before you celebrate that signed term sheet, there's a pivotal step in the process that can determine the fate of your fundraising efforts. It's called due diligence. And it's a comprehensive examination that potential investors conduct to ensure that your startup aligns with their vision and that there are no hidden pitfalls. Today, we'll guide you through the ins and outs of this process. Now, what exactly is due diligence? You can imagine it as a deep dive into your startup's inner workings. During this phase, investors gain access to confidential information about your company, allowing them to review, verify, and scrutinize every aspect of your business. This process aims to confirm their understanding of your startup and assess any potential risks. Investors often collaborate with external experts, including financial consultants, legal advisors, and technical specialists. Due diligence is a crucial step, especially for venture capital investors who rely on pooled funds from limited partners. A meticulous due diligence helps them uncover any underlying issues and prepares them for potential risks. There are often three main types of due diligence that investors will conduct. We'll help you understand these areas so you can better prepare for them. The first due diligence performed by investors is often the financial due diligence. This involves a thorough review of your financial records and accounting practices. Investors will assess your financial health, revenue, expenses, profits, cash flow, and other key financial metrics. They will also examine your business plan, your financial model, financial statements, and tax returns, and try to poke holes in every aspect of your finances. The second one is the legal due diligence. This process involves examining your legal documents, contracts, agreements, and other legal obligations. Investors aim to identify potential legal risks, liabilities, and disputes. Items such as incorporation certificates, company bylaws, contracts, intellectual property, and any ongoing litigation fall under this category. Lastly, there's the commercial due diligence process. This process focuses on your market position, customer base, competition, and other factors that could impact your future growth and profitability. This includes reviewing market analysis reports, competitor analysis, distribution channels, and partnership agreements. These three processes are not exhaustive, and other types of due diligences can also be performed. Some less frequently performed include operational, environmental, human resources, and technical due diligence. As their name states, they all focus on different aspects of your business. The type of due diligence conducted by the investor often depends on the industry your startup is active in, the maturity of your company, or the use of asked funds. To ensure a smooth due diligence process, there are some key steps you need to take. The first one is to organize and update documents. Make sure that all your relevant documents are up to date and well organized. Having an easily accessible data room can significantly streamline the process. It may sound obvious, but you also need to thoroughly understand your business. Be ready to explain every aspect of your business in detail. Understand your value proposition, your business model, your competitive landscape and revenue streams, as well as your growth strategy. Also, you might want to engage experts. Don't hesitate to bring in professionals like financial advisors, legal counsel, or industry experts to help you to prepare for your due diligence process. They can provide you with valuable insights and help you address potential issues. An important step in the entire due diligence process is transparency. Be open and honest about your business's strengths and weaknesses. Trying to hide issues can damage trust in the long run. Lastly, prepare for in-depth questions. Always be ready to provide clear and concise answers to detailed questions. Prepare a frequently asked questions document to anticipate investor questions. Now, you might be wondering how long the due diligence process takes. Well, it can vary from a few weeks to several months. During this period, investors and their advisors will continually request detailed information and ask probing questions. Some investors might even ask for exclusivity, which means you won't be able to engage in due diligence with other investors for a certain period. This can speed up the process but also requires strategic planning. Remember, due diligence is not just about verifying facts. It's also about building relationships and trust with potential investors. By being well prepared, transparent, and professional, you can ensure the process goes smoothly and enhance your chances of securing that all-important investment. Before we wrap up, here's a pro tip. A well-structured data room can make or break your due diligence process. Spend time preparing a virtual data room and update it periodically to ensure it's always ready for future rounds. Just remember to share it only with investors who have signed a confidentiality agreement. Stay tuned for our next podcast episode, where we will dive into the decision process of investors. Thank you once again for tuning in to the Fundraising on the Go. See you in the next episode.